What's up, everyone? Marcus Warren here with your not so weekly tax tip. So let's talk unearned income because not all income is the same in the eyes of the tax code. So the tax code, they use jargon that can be confusing for the unwary, right? And one of them that impacts most of us is the term unearned income. Now, the term unearned income is often defined as anything that is not earned income. Now, if you find this kind of definition a little too vague, let me give you some clarity. So, before I provide the definition of unearned income, let's do this. Let's take a quick look at what is typically included in both earned and unearned income. Earned income includes salary, wages, tips, taxable scholarships, fellowship grants. Generally, employees will typically see this recorded in an annual W-2 tax form. Now, unearned income includes taxable interest, ordinary dividends, and capital gain distributions. It also includes unemployment compensation, taxable Social Security benefits, pensions, annuities, and distributions of unearned income from a trust. And so most of this income is often, but not always, recorded using a 1099 tax form. So why does all this matter? Well, if the tax code was simple, it really wouldn't matter one bit whether your income was earned or unearned income. But it's not the case. Now, here are some things to consider. So first is different tax rates. While most earned income is subject to ordinary income tax rates up to 37%, unearned income can be subject to different tax rates. So long-term capital gains and certain dividends, for instance, are generally subject to lower capital gains tax rates. And these tax rates can max out at 20% before the net investment income tax is applied, which is 3.8%. Another thing, there's also the kiddie tax, right? Kiddie tax rules. So the tax code limits the amount of unearned income that can be taxed at your dependents, which is usually a lower income tax rate. So amounts over that limit are taxed at the parent's tax rate. And that amount is $2,500 this year for that kiddie tax limit. There's also tax benefit limits. So many tax credits and deductions limit the amount of unearned income you may have and still qualify for a tax break. I'll give you an example. So the earned income tax credit that limits unearned income to $11,000 this year also. And then lastly, you got to remember that timing matters. So what do I mean by that? So sometimes the timing of an event can shift unearned income from ordinary income tax rates to the preferential treatment that capital gains rates get. This is the case when you sell an investment. So if you hold an investment for 1 year or less before selling it, and your unearned income investment gain is taxed at ordinary income, all right? But if you hold it and you sell an investment after 1 year, then that unearned income, you get the more favorable capital gains tax treatment. But the bottom line is this: it's all in the details. So it's important to understand how all elements of income apply to different aspects of the tax code. This is where working with someone familiar with the tax code can help. So remember that. That's your weekly tax tip, or not so weekly tax tip. Until next time.